Section 8. Unit 2, FHA Loan Programs. Introduction and Objectives. Lesson 1, FHA Section 203B, Loans. Lesson 2, FHA Section 203K, Loans for Rehabilitation. Lesson 3, FHA Section 251 Adjustable Rate Mortgages. Lesson 4, FHA Streamline Refinancing Program. Lesson 5, FHA Energy Efficient Mortgage. Meet Ed, who would prefer to live off the grid entirely. He and his wife, Greta, decide to compromise. They're buying the house that makes Greta happy, not the cabin in the woods that Ed wanted, but Ed gets to put solar panels on it. Ed's real estate agent tells him about the FHA Energy Efficient Mortgage (EM) program. The EEM isn't a separate FHA loan program, but one that can be used in conjunction with other FHA loan programs to finance the cost of adding energy-efficient features to new or existing houses. To add the amount needed to make the energy efficiency improvements, an energy consultant measured the home's energy efficiency. She then gave Ed, Greta, and their lender a report that listed recommended improvements for energy efficiency, provided an estimated cost for making the improvements, and an estimate of the energy savings that would result. This helped the lender and Ed and Greta determine which improvements would be most cost-effective. Lucky for Ed, photovoltaic systems are an allowed improvement, as long as their cost is within the limits based on the value of the home. The EEM may be used with a Section 203B or 203K loan. It can also be used with the Section 203H program for victims of presidential declared disasters. Ed and Greta are combining it with a basic FHA loan, the Section 203B program. Similar to FHA's 203K rehabilitation loan program, the cost of Ed's energy-efficient improvements are financed into the mortgage. Ed's contractor is allowed 90 days to complete the improvements, and the work must be verified to ensure that it meets the FHA standards. FHA Streamline Refinance Program. The FHA Streamline Refinance Program allows borrowers who already have an FHA loan to refinance. So what, you say? Here's what: the program allows a refinance without verifying the borrower's income or assets, and in some cases, without even requiring an appraisal. The Streamline program is the simplest and easiest way to refinance an FHA loan. One of the biggest advantages to this program is that it allows for an unlimited loan-to-value ratio. In other words, the borrower doesn't need to have any equity in the property. Therefore, even homeowners who are severely underwater may still be able to take advantage of lower mortgage rates by refinancing with an FHA Streamline. To qualify for a Streamline refinance, the mortgage must already be FHA insured. The refinance must result in a reduction of mortgage payments. The homeowners must be current on their mortgage payments, not delinquent. No money may be taken out. FHA Section 251 Adjustable Rate Mortgage Insurance. The Section 251 program is based on the same requirements for property and borrower as the 203B program, which, as you'll recall, is the basic FHA mortgage insurance program for 1 to 4 family homes. The difference is that the Section 251 program insures loans with adjustable rate mortgages, ARMs. The ARM begins with a fixed rate term, which may be 3, 5, 7, or 10 years. After that, the loan's interest rate is adjusted annually, based on market indices approved by the FHA, and thus may increase or decrease over the term of the loan. FHA sets a maximum number of percentage points that the interest rate may change over the life of the loan. In addition, borrowers must be informed at least 25 days in advance of any adjustment to their monthly payments. Using the FHA 203K loan. Kevin, rehab master, never goes anywhere without his tool belt. When he found a great property that needed a lot of work, he was itching to bring it up to snuff. Fortunately, FHA offers Section 203K insurance to lenders, which enables home buyers to finance both the purchase and the rehabilitation cost of a property through a single mortgage. Existing homeowners who refinance can also use the program. Of course, it was a fair bit of work just to get the loan. Kevin, who is a general contractor, not just a DIY guy, had to provide his lender with a detailed proposal of the work he needed to do, along with cost estimates for each item. An appraiser determined the current value of the home, as well as estimated market value once the rehab was complete, so that a loan amount could be established. Luckily, the combined cost of home value and rehab still fell within the FHA mortgage limit for the area. When Kevin closed on his loan, the amount above what is used to pay off the seller is the amount dedicated for the repairs. The contractor, in this case, Kevin, receives 50% of these funds up front. The rest are placed in an escrow account. Kevin will receive the remainder of the rehab funds when the rehabilitation is completed. He's got 6 months to get her done, according to program requirements, and approved by the 203(k) inspector. HUD requires that the work be completed according to FHA's basic energy efficiency and structural standards. Hadn't saved much for a down payment. Borrowers can qualify for financing with only a 3.5 down payment. Low credit score? Lenders are allowed to consider factors that compensate for poor credit histories. High debt-to-income ratio? Lenders are insured against loss so they can manage the risks.